Hey everyone, welcome to The Explainer. Today, we're going to tackle a really fascinating topic, venture capital. You've probably heard the term, maybe abbreviated as VC. We're going to demystify this whole high-stakes game of startup funding, breaking down how it really works, from the money to the mindset. So let's just jump right in. I want to start by telling you the biggest and honestly the most counterintuitive secret about this entire industry. Seriously, once you hear this, it changes how you see everything else. Okay, check this out. 90%. What do you think this number represents? Is it, I don't know, the success rate of startups? Maybe the cut that VCs take? The real answer, well, it's going to surprise you. Get this. That's the percentage of venture capital funds that don't make money. Yeah, you heard that right. The vast majority of these professional, high-powered investment funds, they actually fail to turn a profit for their investors. So this is the big puzzle, right? It just begs the question, how on earth does this industry even exist? All right, before we get any further, let's just make sure we're on the same page. What is venture capital, or VC? Well, put simply, it's when these professional organizations invest a bunch of money into high-potential startups in exchange for a piece of the company. You know, ownership. A classic example, think of a giant like Sequoia Capital, who got in on Google super early. And you gotta understand, this isn't the kind of money you get for like a lifestyle business or a side hustle. Nope. VC is for the big swings. It's for founders who have these massive, potentially world-changing ideas and need millions, sometimes tens of millions of dollars to even get off the ground. In other words, it's for people who are really shooting for the moon. Okay, so if most of these funds are actually failing, that brings us back to that big question, right? Where in the world does all this money even come from in the first place? You know, to really get inside the head of a VC and understand their mindset, you absolutely have to know where their money comes from. It's a critical detail. Here's the thing. It's not their own money. Venture capitalists, believe it or not, aren't usually investing their own personal fortunes. They're professionals who go out and raise these enormous funds of other people's money. We're talking from wealthy individuals, institutions, pension funds, and then they invest that cash on their behalf. And there's a name for these people and institutions providing all the cash. They're called limited partners, or LPs for short. You can think of them as the silent, deep-pocketed backers of the entire VC world. So the basic pitch a VC makes to its LPs, the core of their promise, sounds something like this. And pay attention, because it comes with a really strict deadline. And that 7-year clock, it's absolutely critical. See, VCs have this very limited window to work with. In the first few years, they're placing their bets, right? They're investing in a whole portfolio of startups. But after that, man, the clock is ticking, loudly. They are under immense pressure to grow those companies at a ridiculous, lightning-fast speed so they can find an exit. That could be selling the company or taking it public with an IPO. That's the only way they can get their LPs' money back, plus, hopefully, a huge return. This whole thing creates an intense, high-pressure environment for absolutely everyone involved. So you take that intense pressure from the 7-year clock, and you combine it with the fact that, let's be honest, most startups fail, and what you get is a very, very specific and sometimes kind of brutal investment strategy. It really all comes down to the math, and the math is pretty wild. VCs don't just expect some of their companies to fail, they plan on most of them failing. The whole model is built on this idea that if they invest in, say, 10 companies, 9 of them are probably going to go to zero. They're just going to fizzle out. So for the whole fund to actually make money, that one single winner has to be an absolute home run. I'm talking a massive success that's big enough to cover all the other losses and still generate a huge profit. Okay, so let's make this super practical. Imagine a VC is looking at 2 different investment opportunities. You've got company A, which is a pretty safe bet, like a 90% chance to double their money. Then you've got company B, which is a total long shot, but it has a small chance to deliver a massive 20x payoff. So which one do they pick? I mean, the safe bet seems logical, doesn't it? A 90% chance to double your money, that sounds pretty great. But for a VC, because of the math we just talked about, the choice is actually obvious, and it's probably not the one you're thinking of. They pick company B, the long shot, every single time. And why? Because doubling their money on one deal just isn't going to cut it when 9 of your other investments go up in smoke. It just doesn't work. They need that potential 20x moonshot to have any hope of returning the fund. See, they're hunting for unicorns, not just reliable workhorses. And this single-minded obsession with finding that one massive winner, Well, that's what shapes the entire startup ecosystem. It's why explosive hypergrowth is rewarded above all else. All right, so now that we've got a handle on how they think, let's talk about where you can actually find these VCs, because they're not just scattered everywhere. It turns out venture capital firms tend to pop up and cluster in places that have a very specific kind of chemistry. You really need two key ingredients. First, a ton of wealthy people, that's the capital, and second, top-tier universities, that's the talent, a steady stream of smart, ambitious people ready to build something new. Now, you can find VCs in big cities all over the world, London, Beijing, you name it. But one area just completely dominates the landscape. I mean, it's wild. A staggering 90% of all venture capital money is spent in just one single region. And that place is, of course, Silicon Valley. For anyone who doesn't know, that's basically the geographic area between San Jose and San Francisco in California. It's a pretty small strip of land, but it's the undisputed heavyweight champion of the world when it comes to venture capital, big deals, and startup culture. Okay, so this raises a huge question. What if you're a founder with a brilliant moonshot idea, but you're not in Silicon Valley? How in the world do you get on the radar of these professionals who are getting bombarded with hundreds of pitches every single week? So, how do you cut through all that noise? Well, here's the game plan. Step 1, get a warm referral. Seriously, never cold email. VCs are drowning in pitches and they use their trusted networks to filter everything. A cold email is just a waste of time. Step 2, be where they are. You've got to go to the meetups, the pitch competitions, hang out in the online hubs where they look for deals. You have to be part of the conversation. And step 3, and this is huge, have proof. An idea on a napkin isn't going to cut it. You need to show them you have a real business with actual revenue to prove you can actually build something. All right, so let's fast forward. Let's say you actually do it. You navigate this whole crazy world, you get the meeting, you land the investment. That's amazing, but it's absolutely crucial to understand what you're giving up in the process. There's always a trade-off. Look, taking VC money is a massive trade-off. It's a deal with the devil, some might say. On the pro side, you get access to millions in capital, rocket fuel for your idea. Plus, you get their professional expertise and their incredible network. But the cons, they're serious. You're giving up a huge chunk of your company, maybe 40% or more. And even more importantly, you lose control. Make no mistake about it, the moment you cash that check, you have a boss. And if you're not performing, they have absolutely no problem replacing you, the founder, if they think it's what's best for their investment. And that really brings us to the final, critical question you have to ask yourself. VC funding can give you the fuel to genuinely change the world, to make your moonshot a reality. But it always comes at a steep price. So the question you're left with is your moonshot worth it?